All right, time now to bring in our halftime headliner. We're talking Kevin Simpson, founder of Capital Wealth Planning. He manages the firm's five-star fund. And Kevin, you're adding protection on one of your big tech stocks.
Well, you guys did a great job breaking down the tech earnings, especially Microsoft. And we look at these opportunities, these surges, and believe me, we love the name, but sometimes these multiples get stretched. So we're not going to try to time in and out of the position. But writing covered calls is a great way for viewers, for investors, to hedge a position that may have taken, a meteoric run. And certainly Microsoft could be in that category. They had great earnings 2 days ago, another surging number yesterday in terms of performance. So we wrote covered calls yesterday on Microsoft. We wrote $320 calls. And could it get there? I mean, you mentioned AI, and it seems like everybody's pulse skips a beat. But I think this is an opportunity where trees don't grow to the sky. So if we can put a little bit of a hedge out there, if you own a position that's getting too much of an overweight within your portfolio, not a bad idea to trim into strength. But it's not a judgment on the name by any means, Frank. We're just trying to read the room.
All right, so as you're reading the room, what areas are you looking at? I mean, obviously, we're talking about your covered calls when it comes to big tech, but what other areas are you looking at? Because we've seen such a really resilient U.S. consumer. They just continue to spend.
Yeah, you can't discount the resiliency, not just of the American consumer, but of the stock market in general. And granted, it might be isolated with a few big name stocks that are really pulling up the indices, but look at the move that we saw yesterday. I mean, everyone on Wall Street, to a person, is so negative. So many people that sit on the desk there during the week are so negative. Not you, Jim, but there's lots of negativity. And when you see this type of market move to the upside, you have to respect that resiliency. You mentioned McDonald's in the introduction a second ago. I mean, here's a stock again at 52-week highs, really with a stretch multiple, very similar to the Microsoft conversation. Another name that we've been trimming, straight up trimming, and writing covered calls against. Now, a couple things that we did add to this week, Frank, one of which may sound somewhat counterintuitive, but maybe leans on the strength of the consumer, is Home Depot. And I realize that naming a cyclical position in light of what could become a recession may seem a little counterintuitive, but it was 10% down off of its highs in just a few short days. And we always look at these things not over a 3 to 6 month period, but a 3 to 6 year period. This is a stock that we're building the position out. We've owned it for a long time off and on. And if we see pullbacks, which we certainly can and probably will over the summer, we'll continue to add to it. Same thing with Merck, resiliency within the healthcare space, 2.5% dividend, looking for opportunity sets, again, finesse trades, not big major moves, but just taking advantage of what the landscape is giving us and trying to make the best decisions here in the short term to benefit us in the long term.
Hey, Kev, one more question. You're about 15% cash right now. Why not just put that in a short-term bond? I'm looking at the 2-year yield above 4% right now.
Should I go into a 2-year?
I'm asking, you're the five-star fund manager.
Well, here's the problem. We go into a 2-year, you can rest assured Murphy's Law is sitting on my shoulder that the market will capitulate and go to the upside 1 year in, and we'll miss a big run to the bull market. So as attractive as those yields are, I think you're always going to do better off owning companies in the stock market that pay dividends, that increase dividends. And when you factor in where inflation is right now, I know we're all excited that it's coming down, but it's still a far cry from the Fed's 2% target. And when you factor in inflation, that yield doesn't look quite as attractive over a 2-year period. Now, for financial advisors who are allocating for clients, by all means, it's wonderful to get a yield considering the past 12 years where we've seen bond markets with almost barely a pulse. But for me, give me stocks all day long.
All right, there we go. Kevin Simpson, appreciate the insight. We were just talking Eagles earlier today. Big day for the Eagles, man.